Investors beware, the cost of ignoring risk management. Welcome, fellow investors. Today we're diving into a critical yet often overlooked cornerstone of successful investing, risk management. Even the most experienced investors, fortified with years of knowledge and success, can stumble when they ignore this essential principle. Let this video serve as your compass, highlighting the hazards of complacency and equipping you with practical strategies to safeguard your financial aspirations. Remember, the most successful investors are not those who take the most risks, but those who actively manage and mitigate them. Let's begin your journey toward more secure and sustainable growth. Every decision in investing comes with an element of risk. Whether you're diversified across asset classes or holding a concentrated high-growth portfolio, risk stands as an ever-present factor. Yet many seasoned investors mistakenly adopt a sense of invincibility fueled by past success. Overconfidence begins to erode discipline. But let me paint a picture for you. Imagine building your portfolio brick by brick, only to ignore the cracks forming in the foundation. Over time, those cracks, small, seemingly insignificant, can be your undoing if not addressed. The truth is that risk doesn't just come from volatile markets or unpredictable events. It sprouts from complacency, from assuming that your hard-earned experience alone will shield you from failure. Ignoring the principles of risk management is akin to playing in traffic with a blindfold on. What's the price of neglecting risk management? Let's start with the financial toll. Investors who fail to diversify, hedge, or protect their portfolios leave themselves exposed to significant market downturns. A stock market crash or an unexpected global event has wiped out countless portfolios in the past, and it can happen again. But financial loss is only part of the story. There are emotional costs tied to failed risk management. The mental strain of watching your portfolio plummet beyond your control can lead to frustration, regret, and even decision paralysis. These emotions often push investors toward poor, impulsive decisions, liquidating assets at the wrong time or doubling down on unsustainable risks in a desperate bid to recover losses. Take a moment to reflect on the valuation bubbles, like the dot-com crash or the 2008 financial crisis. Many investors, both inexperienced and seasoned, fell prey because they ignored risk mitigation principles. They were optimistic, even euphoric when markets surged, but blind to the approaching cliff. Do you want to be next in such a story? Risk management isn't complicated, but it is deliberate. The guiding principle is simple. Prepare for uncertainty, not predict it. No crystal ball can offer you a perfect view of future market behavior, but there are tried and true strategies every investor can embrace. Diversification is your first line of defense. By spreading investments across a mix of asset classes, you reduce the impact of any single loss. Stocks, bonds, real estate, commodities, or even alternative investments can balance one another when markets are volatile. Picture this as not putting all your eggs in one basket. Even if one basket falls, you'll have others intact. This reduces your overall exposure to catastrophic loss. Diversification demands focus not just on industries and geographies, but also on asset types such as growth versus income investments. Periodic portfolio reviews are essential to stay aligned with your financial goals. Markets evolve, and so should your portfolio. Sticking rigidly to past allocations can drag your returns, especially in a changing economic environment. Portfolios can tilt over time, perhaps becoming overly concentrated in risky assets or leaning too heavily toward conservative ones. Regular adjustments ensure balance. Think of this as a health checkup for your investments. Neglect the checkup, and you might miss the signs of trouble. Stop-loss orders act as a safety net, automatically selling a position when it drops to a specified price, helping to lock in profits or minimize losses. While viewed as more tactical than strategic, tools like stop-loss orders are invaluable during high market unpredictability. Hedging through financial derivatives or inverse ETFs can also reduce downside risk. These instruments might not be appropriate for all investors, but they are worth exploring for more advanced portfolios. Understand your risk-to-reward ratio with each investment decision. Before committing capital, evaluate whether the potential rewards justify the risks inherent in the investment. For instance, would you risk $1,000 to make $100? Likely not. This fundamental analysis forces clarity in decision-making. Are you chasing returns at the expense of good judgment? The right answers, backed by solid risk-reward evaluations, are the cornerstone of prudent management. If ignoring risk management has been the norm, starting fresh can seem intimidating. But rest assured, every improvement begins with a single step. Let's break the process down for you. Evaluate your portfolio for vulnerabilities. Begin by assessing the risk exposure of your current investments. Is your portfolio overly reliant on a single industry or market? How would your portfolio fare in worst-case scenarios, such as a market crash or a sharp recession? Align investments with risk tolerance. Risk tolerance isn't static. It changes with age, financial goals, and market conditions. Revisit your financial objectives. Are you aggressively pursuing growth, or are you aiming for stability? Adjust your mix of assets to reflect your present goals. 3. Explore tools for risk mitigation. Take advantage of tools like trailing stop orders, exchange-traded funds, and risk analytics platforms that provide deeper insights into potential vulnerabilities. Technology enables you to monitor your portfolio performance daily, allowing for prompt adjustments. 4. Engage advisors or mentors. Even experienced investors benefit from partnerships with certified financial planners or peer groups. An outside perspective can shed light on blind spots you might miss. Begin with these manageable steps, and you'll soon discover how empowering it feels to have a portfolio fortified against uncertainty. One of the greatest takeaways for any investor, whether new or experienced, is to see mistakes as lessons instead of failures. If you've previously suffered losses or found yourself underprepared for a market downturn, recognize that these experiences hold the seeds of growth for the future. The financial world can be unforgiving, but learning how to adapt is our strongest tool. Embrace a growth mindset that values resiliency. Analyze past mistakes objectively to identify areas where your strategy faltered. Did you take on too much risk without a plan? Did you follow market trends without doing research? Use these reflections not to dwell on regrets, but to build a stronger framework going forward. Proactive risk management doesn't just prevent losses, it positions you for sustained growth. The key difference between short-lived investors and those who build lasting wealth boils down to this single principle: how well they manage risks when the market challenges their plans. When you adopt risk management as a habit, you won't just be reacting to problems, you'll be strategically navigating them. This approach transforms challenges into opportunities, disasters into manageable setbacks. Moreover, consistent practice of these principles gives investors emotional confidence. You can engage in investing without the fear of devastating losses lurking in the background. Once anxiety is minimized, clarity in decision-making follows. Now that we've explored the cost of ignoring risk management and the pathways to secure your financial success, it's time for action. Take a moment today to review your portfolio. Ask yourself, am I prepared for uncertainty? Have I controlled my exposure to risks? If the answer is no, don't delay. Align your strategy with a mindset of vigilance and growth. Keep learning, keep adjusting, but most importantly, protect what you've already built. Remember, risk is inevitable, but unpreparedness is optional. The tools, strategies, and mindset you adopt today will set the groundwork for decades of financial resilience. Finally, if this message resonates with you, share it with your investing peers. Let this become a movement where investors empower one another by prioritizing preparation over mere prediction. Until next time, keep investing wisely and never underestimate the power of risk management.